Imagine a tripwire in the financial system that almost no one saw. A wire set to snap, not at a specific time, but at a specific price for an ounce of silver. This past week, that wire didn't just snap. It may have activated a kill switch that the major banks can no longer control. The price of silver has done something absolutely extraordinary. As of December 23, 2025, it has surged to over 130% since the start of the year, blowing past every mainstream projection. Prices didn't just touch $70 an ounce, they tore past it, hitting an all-time high of $71.16, a level that was unthinkable just months ago when it was trading at around $29. This isn't just a rally, it's a seismic shift, and according to a powerful theory taking hold in the market, this move has triggered a doomsday machine assembled years ago, hidden deep inside the derivative books of the world's largest banks. The crisis they've been hiding for years might finally be out in the open. What we're witnessing isn't a random price spike. It's the result of a fundamental structural breakdown, and it starts with one number, $67. For years, the financial establishment has pushed a single story. Silver is just an industrial metal, a poor man's gold, volatile and easily controlled. They built a dam of paper contracts to suppress its price, a dam they believed was unbreakable. But what happens when the flood of reality becomes too powerful to hold back? In December 2025, that dam broke. Silver's price didn't just rise, it exploded. It's now up over 130% since the start of the year, a performance that has left gold and the stock market in the dust. The mainstream media, when they bother to mention it, will tell you that it's because of the usual suspects, the expectation of Fed rate cuts, geopolitical tensions, and a weaker dollar. And sure, those are contributing factors, but they aren't the explosive charge, they're merely the spark. The real story, the one they hope you don't hear, is about a catastrophic bet made by some of the biggest financial institutions on the planet. For years, these banks have held massive short positions against silver, betting the price would stay low forever. This strategy worked for a long time, letting them profit from a market they manipulated with impunity. In fact, back in 2020, Morgan Chase even admitted to manipulating precious metal markets for 8 years and agreed to pay a staggering $920 million fine. That wasn't a punishment, it was just the cost of doing business. But their strategy had a fatal flaw. It was built on a foundation of paper, of promises and future contracts that vastly outnumbered the physical metal available to back them up. And that flaw contained a time bomb, a trigger set to go off not at a specific time, but at a specific price. The theory rapidly gaining traction is that the trigger price was $67. So what is the $67 trigger theory, and why is it so dangerous for the banking system? It's a mechanism believed to be hidden in the complex world of derivatives and margin calls. Here's how the trap was supposedly set. Between 2020 and 2023, major banks allegedly built up their massive short positions at an average price around $22 to $25 an ounce. They were effectively selling silver they didn't own, confident that they could always buy it back cheaper or just roll the paper contracts forward forever. But markets have a way of calling bluffs. The theory goes that when silver's price crossed $67 on its way to $70, it hit a critical threshold. At this level, derivative contract rules are said to activate automatic margin calls that can't be stopped, delayed, or negotiated. This isn't a polite request for more collateral, it's an automated demand for cash to cover their entire losing position. If they fail to post the cash, the contracts are liquidated automatically, forcing the banks to buy back their shorts at the current ruinous market price. And the timing of this event, hitting its peak on a Friday, is what turns a big problem into a full-blown crisis. When these margin calls hit, the markets are about to close for 48 hours. The banks are trapped, there's no Federal Reserve to call for an emergency weekend loan, there are no backroom deals to be made, there is only a black hole of liquidity pressure building for 2 straight days, threatening a major solvency event by the time markets open on Monday. This is the kill switch. It's a doomsday machine of the bank's own making, designed to enforce discipline in the derivatives market, but never intended to be triggered against the very institutions that run it. They created a system to control the price of silver with paper, but they forgot one crucial rule. You can't print physical metal. Now, does all this sound a little too dramatic to be true, like some wild conspiracy theory? Well, history doesn't just rhyme, it often repeats itself. The playbook for what could be happening right now was written decades ago. Think back to 1980 and the Hunt brothers. They understood the disconnect between the paper price of silver and the finite physical supply. They started taking physical delivery, calling the bluff of the paper markets. As they accumulated the metal, the price soared from $6 to nearly $50 an ounce. putting the banks and brokerages who were short on the hook for massive losses. How did the establishment react? Did they let the free market play out? No, they changed the rules. The Commodities Exchange, COMEX, with the backing of regulators, instituted a rule that became known as Silver Rule 7. It restricted trading to liquidation only. You could sell your silver contracts, but you couldn't buy new ones. It was a coordinated, top-down intervention designed for one purpose: to crash the price and save the insolvent banks. And it worked. The price collapsed, and the Hunt brothers were ruined. Now let's look at today. Rumors are swirling of an emergency closed-door meeting at the CFTC, supposedly held on December 19th, to discuss the market stabilization measures. While the existence of this meeting is debated and unconfirmed by official sources, the chatter itself points to a building panic. Proponents of this theory are asking, is this history repeating itself? Are the regulators getting ready to change the rules once again to save the very same institutions that created this mess? The crucial difference this time, however, is the physical market. In 1980, there wasn't a massive underlying physical shortage. Today, the situation couldn't be more different. The paper games played by the banks can only last as long as they are loosely tethered to reality. For silver, that tether is now snapped. The physical market is screaming that something is fundamentally broken. According to the Silver Institute, the world is facing its 5th consecutive annual supply deficit. Projections for 2025 show a shortfall of around 117 million ounces. Think about that. For 5 straight years, we have used more silver than we have mined and recycled. This has created a cumulative deficit that has eaten through the above-ground stockpiles at an alarming rate. Where is all this demand coming from? It's not just investors. Silver is an indispensable industrial metal. It is the single most conductive element on Earth, making it essential for the green energy transition and advanced technology. Every solar panel, every electric vehicle, and every AI data center requires huge amounts of silver. The solar industry alone now accounts for a staggering portion of all silver consumption. This isn't a cyclical demand that disappears in a recession. It's a structural, foundational demand that is only set to grow. While industrial demand creates a high floor for the price, another global giant is lighting a fire under it. India has taken a historic step toward the remonetization of silver. The Reserve Bank of India has announced new regulations set to take effect in April 2026 that will officially allow silver to be used as collateral for loans. For the first time in the modern era, a major economy is formally recognizing silver's monetary role alongside gold in its banking system. This move is expected to unlock the value of the vast amounts of silver held by Indian households, creating a massive new source of demand and further tightening a global supply chain already stretched to its breaking point. This is the perfect storm: soaring industrial demand, a structural supply deficit, and now the remonetization of silver by the world's most populous country. The physical market is in charge now, and it couldn't care less about the paper contracts traded in New York and London. It's clear the financial system is on shakier ground than most people realize. The story of silver is a huge warning sign for a much broader crisis. If you want to get analysis that cuts through the mainstream noise and tells you what's really going on behind the headlines, make sure you subscribe to this channel and hit that notification bell. You don't want to miss what happens next. So what does all this mean? It means we're likely entering the end game. The battle lines are drawn, not just in the silver market, but for the future of money itself. On one side, you have the banks and regulators who will do anything to maintain the current paper-based system. On the other, you have the undeniable reality of physical supply and demand. The split in price predictions from financial analysts tells the whole story. The old guard, the establishment banks, are still hoping they can put the genie back in the bottle. Citi, for instance, has recently put out a target of $42 per ounce, suggesting a retreat. But a growing chorus of independent analysts see the writing on the wall. Economist Peter Schiff has called a move to $100 an ounce a realistic target for 2026, warning that what we're seeing is not a bubble, but a long overdue reset as confidence in the dollar evaporates. And some projections go even further, looking at the sheer scale of monetary debasement and the supply deficits, with models suggesting paths well into the triple digits. These numbers might seem shocking, but they are the mathematical result of a system where physical scarcity finally overwhelms paper promises. The most important takeaway in all of this is the difference between paper and physical. The bank's entire price suppression scheme was built on the world of paper silver, ETFs, future contracts, and unallocated accounts. These are IOUs, promises for silver that, as we now may be discovering, might not exist in the quantities claimed. The ratio of paper claims to physical silver has been reported by some to be as high as 250 or 300 to 1. When the music stops, the only thing that will matter is who is holding a physical chair. Physical silver, the metal you can hold in your hand, has no counterparty risk. It cannot be defaulted on. It cannot be printed into oblivion by a desperate central bank. It is the ultimate insurance against a system that has proven itself to be corrupt and unstable. The events of this past week are more than just a spike on a chart. The surge past $67 an ounce was a shot heard round the financial world. It was a signal that the decades-long manipulation of the silver market today may be coming to a violent end. The kill switch, whether a formal mechanism or just the breaking point of market reality, appears to have been activated. The banks are trapped in a corner of their own making, short a physical commodity whose industrial demand is exploding while its supply is dwindling. Regulators may attempt to intervene, just as they did in 1980, but this time is different. The underlying physical market is far stronger, driven by an industrial revolution in green energy and monetary revolution in the East. Trying to cap the price now would be like trying to cap a volcano. It might be able to temporarily disrupt the paper price on one exchange, but they cannot stop the global demand for physical metal. We are witnessing the great decoupling, where the price of real physical silver breaks free from its paper shadow. A massive wealth transfer may be unfolding right before our eyes. This is no longer a question of if, but when. The tripwire has been triggered. The banking crisis, set in motion years ago, is now in play. The only question left is, on which side of this historic shift will you be? Do your own research. Understand the difference between a promise and a possession. The clock is ticking.